Welcome to the Strategic Management Accounting course, where we teach the value-adding steps and processes necessary to execute strategy. Whether you are just starting up or looking to grow your business, then this course is for you. With your host, Dr. Neil O'Connor.
Hi, this is Neil. Welcome back. And this is week 2. We're just getting started and there's so much stuff to get into. This is chapter 13 of edition 15 of the Horngren Cost Management textbook. And we're looking at pricing decisions. So what do we mean by pricing decisions? Chapter 13 really takes you through what is information you need for pricing and what are the influences on pricing. And basically it is customer, it's a competitor, and it's basically the costs. So just to kick us off, I want to take us through a pricing example where you actually get to make a decision. You get to make a decision whether to actually sell a product or not sell a product. And so let's get into this example, shall we? Here we have the financial data that applies for a videotape production plant of Dill Company. That's a nice name. October 2009. Getting a bit old. Videotape. They don't make videotapes today, do they? Maybe in some countries, but not that I see in Hong Kong. Anyway, let's get on to the budgeted manufacturing cost per videotape. We have direct material of $1.60 and we've got direct manufacturing labor of 90 cents. Variable manufacturing overhead of 70 cents. Fixed manufacturing overhead of $1, total manufacturing costs of $4.20. Now what we learned in job costing, activity-based costing, is that some of these costs are direct costs and some of them are indirect costs. And not all costs are necessarily relevant for a particular decision. So the relevant decision in this case is going to come up in a minute, where some salesman asks the boss, can we sell this product for less than $4.20? We'll look at that in a minute. But let's just note here, we've got variable manufacturing overhead that varies with the number of units produced. We have fixed manufacturing overhead of $1 per tape, and it's based on budgeted fixed manufacturing overhead of $150,000 per month and a budgeted production of $150,000. Now we remember what I noted when we're talking about job costing, and the idea of using normal costing or standard costing is we need to make these budgeted allocations because we don't know the actuals and we need to set a price. And often we don't know the actual costs until we make the thing and sell it, but we need to tell the customer how much we're going to sell it for. And so that's why we get into budgeting, and we have a budgeted allocation to get a fair idea. Are we going to make money on this product or we're not going to make money on the product? So this is the whole idea of actually applying a budgeted overhead amount, because some people think, well, why don't we wait for the overhead to be actually incurred, then divide it by the actual number of units, then we'll know how much we should sell the product for. But that's too late. That's after the fact. The sales have happened a month before or 6 months before. You see that? So we've always got to have some budget allocation so we can get a fair idea of pricing, so we get a fair idea of how much money we're going to make per unit. So let's just get into this exercise, shall we? So next slide. There are marketing costs. One extra cost that we need to consider, marketing costs, and they're not normally in the cost of goods sold. They're normally in the selling, part of the selling expenses in the bottom half of a profit and loss statement. So we've got variable marketing costs of 5% of revenues and fixed monthly marketing costs of $65,000. Yeah, there you got it. You can see it in the green. Now, during October 2009, Lynn Randall, a Dill Company salesperson, asked the president for permission to sell 1,000 videotapes for what? $4 per tape. Outrageous. How can you sell it for that cheap when it's $4.20 to make, right? And guess what? Guess what the president said? No way, this is so much lower than our manufacturing cost per unit of $4.20 as we have allocated. And so I'm going to refuse the order if I'm the president because the selling price is below the total budgeted manufacturing costs. So here's the problem. What would be the effect on monthly operating income of accepting the special order? Next question, comment on the president's below manufacturing cost reasoning for rejecting the special order, and what other factors should the president consider before accepting or rejecting the special order? Now let's get back to what we talked about in week 1. At the end of the day, we want information so we can make a better decision. You see? So the only information that enables us to make a better decision is the relevant information that changes between going ahead with the decision and not going ahead with the decision. So let me ask you before we go to the next step, will the manufacturing overhead, the fixed manufacturing overhead, will that change as a result of making this decision? Yeah, you got it. No, it won't change. So therefore, that portion of the manufacturing costs should be taken out. Are there any other costs that may not change as a result of making the decision? Let's have a look here. What about the fixed monthly marketing costs of $65,000? Do you think that would change? I don't think so. So therefore, we need not consider that in making the decision, you see? So when we go to the next page, what we're going to do now, especially the requirement number 1, is to try and work out what would be the effect on the income, the monthly income of accepting the decision. So let's go and have a look at the next slide, shall we? Now we've got relevant revenues of $4 per unit. That's the offer times 1,000. So that's $4,000 as the extra revenue. What about the extra costs? Well, we have direct materials. Okay, that's relevant. We have direct manufacturing labor. That's relevant, 90 cents. We have variable manufacturing overhead, 70 cents. Now remember, it's variable manufacturing overhead. That's going to change. It's going to go up and down whether you accept the order or not. But fixed manufacturing overhead is going to stay the same. Yeah, you got it. So what else is variable? What other costs are likely to change as a result of accepting or not accepting this order? You got it. Variable selling costs of 5% of the total revenue. So let's add up these, shall we? $1.60 direct materials times 1,000 is $1,600. 90 cents of direct labor times 1,000, $900. $700 of variable manufacturing overhead, and 5% of 4,000 gives us $200 of selling costs. So the total relevant costs in this case is $3,400. Let's take that off the revenue, $4,000. So the increase in operating income is $600. So on the basis of this, if the purpose of the decision, yes or no, is dependent on will we make more money this month as a result of making that decision, then the answer is quite simple. Yes, a big yes. It's easy. It's $600 more in the money. Yay. Okay, now let's be careful here because the calculation assumes that the fixed manufacturing overhead will not change. Remember, we didn't include that in the calculation. And the $65,000 of monthly marketing costs remains unchanged by accepting the 1,000 unit order. One more point, that the price charged and the volume sold to other customers are not affected by a special order. You can imagine other customers find out, you giving it to this customer, Ray. I'm paying $5 per unit. I just ordered 10,000. You better give me a discount. Knock $1 off each unit I just purchased. Otherwise, I'm not going to order from you again. You can imagine the outrage from other customers if they find out that you are secretly discounting for a special order. You understand this problem here. So let's go to the next stage of the questioning of the reasoning of this exercise. So we want to make very clear that the president's reasoning is defective on at least two counts. And the the president's reasoning included irrelevant costs, that is, the fixed manufacturing overhead. It is irrelevant to the decision. And the president really didn't include a relevant cost, that is, the variable selling costs of 5% of the selling price. That was excluded, but it should be included. And so that's how you get a more accurate decision, by only including those relevant costs that are relevant to that decision. Now, let me define relevance again. Any costs are relevant if they change as a result of going ahead or not going ahead with a particular decision. Okay, the final part of this exercise, and we want to look at the key issues. And there are two big key issues to consider, and these are more qualitative issues. The first one is the impact on the customer base. And I've already alluded to that earlier. Other customers may get very angry if they find out you're discounting to a special order. Maybe that special order, they go out and then sell it again for $4.50, which is still below the price you've been charging other customers. It happens, so don't nod your head that this doesn't happen. Okay, so keep in mind, you must be loyal to your customers. Now let's get back to a point that marketing strategy that happens on the internet these days is that often you're allowed to get in early to a particular mastermind or a online mastermind group. You may have to pay some money, some entrance fee, like $200 a year, or $500 or $600 for a lifetime membership. What tends to happen with these mastermind groups is that they actually increase the price of entrance by 5% or 10% every year. So it gives you the feeling of, when you get in early, that you've got into an increasing asset over time. So that is a marketing strategy, a market pricing strategy that a lot of internet marketers work with today. So look out for that. Think of a strategy like that you have seen online in the past few months. Now, the second key issue we want to keep in mind is, maybe this is a once-off, or is it a new sales channel that we have not yet explored? And so we may be just testing a new market, you see. And so this is very important, because if it's a one-time only order, then maybe we go ahead with it. We've considered all the costs and we're not going to do it again. However, because maybe we have excess capacity, so we can do that. However, if it's likely to be a long-term order, then we need to think how it's going to affect the existing sales. And if it's going to be long-term, then we need to start to think about, we need to allocate some of that fixed overhead. We need to allocate some of that fixed marketing costs, you see. So there we have it. We have a decision. At the start, that $4 was much lower than that $4.20 allocated, budgeted manufacturing cost per unit. But that budgeted manufacturing cost per unit included some irrelevant costs that did not change with the decision. What was that? Fixed manufacturing overhead. And it excluded a relevant cost, that is variable marketing expenses of 5%. So you had to exclude that fixed manufacturing overhead. You had to include that 5% marketing cost to arrive at a relevant unit cost to make the right decision. Then, even when we have thought we have made the right decision, we need to think of the qualitative considerations. Number one was, what is the effect on the existing customer base? And number two, is this going to be a once-off or long-term? If long-term, then we need to think about making relevant these fixed manufacturing overhead or fixed marketing expenses. So that's the beginning exercise I want you to consider. As we go into chapter 13, we'll look at a few more exercises in that chapter. But that's what pricing is all about. It's actually making decisions that balance the demands of customers, that balance your competitiveness compared to your competitors, and also that balances the costs that you are incurring to make the product. Let me repeat, we need to balance the demands of customers. We need to balance your competitiveness with your competitors, and you need to cover your costs in the long term at least. So there you go. Let's get into this pricing chapter and see you on the inside. Thank you.